and varied. And I think that's why it's going to be such an interesting session. We're going to have a bit of a segue into this session by having Governor Jonsson give a little talk, and his remarks are actually going to carry on from that first session. The governor referred to FPAS Mark II, okay, and you might notice I wasn't in the first session talking about FPAS Mark II, but I want to tell you a little bit about the ideas, okay, because once you get into FPAS Mark II, you apply it to everything you think about. FPAS Mark II gets rid of the idea of a baseline, okay? And when we think of FPAS Mark II, we think of scenarios, okay? And we train a staff to think about all the different kinds of scenarios that could affect us, and then try to plan policies to guard against what Olivier Blanchard refers to as dark corners and so on. And so in our monetary policy discussions, we talk about case A scenario as one where the central bank has to work harder by raising interest rates to bring inflation back to the target. So we call that a case A scenario where we have to work harder. A case B scenario is a scenario where we have to work not as hard. We don't have to raise interest rates maybe as much, or we could cut interest rates by more than what's priced in financial markets. So I just want you to think about case B as you have to work less hard. And case A, you have to kind of work harder. And it's good for us, when we organize our thoughts, to think about when do we have to work harder? Okay, when don't we have to work so hard? And so I want to use that to kind of couch the frameworks that we're thinking about today and all of the issues that we're going to cover in this topic, to think about climate change. Case B, it's all a hoax. Basically, it really doesn't matter very much, and so we don't do anything, and we get lucky. That would be case B. Case B would be that we get great data. In other words, we develop new ways of measuring data, including text, that allows us to understand the economy better, not only where it is today, but what the underlying forces are. And of course, the transmission mechanism, which was very much a topic of the previous discussion. How does all that work? Okay, and in my world, my case A world, I don't think we know anything about that as an economic profession. I spent most of my life trying to think about those kinds of issues, and I would describe the glass as being well less than half full. It's best to recognize what we don't know and understand a little bit about the implications of what we don't know, because the risks for financial stability are enormous. Now, the other positive thing, case B, artificial intelligence saves us. We get a big increase in technology from artificial intelligence. Now, believe me, I was skeptical about artificial intelligence, but I've completely changed my mind about this. This is happening. I just got back from Mumbai. This is happening, and it's happening now, and it's going to have dramatic implications for the income distribution. And that's a case A scenario where if we do a better job at digitalization, we could potentially think about a better income distribution system. In other words, if we could get people with bank accounts at the central bank, for example, we can get money to the people that need it, as opposed to what happened during COVID, where we had this massive fiscal expansion in the US, obviously, to people that did not need that. So I'm going to ask those questions to our panelists, or to Bruno. Are the data going to get us out of this mess and help us understand things? And we're going to talk about climate change and is it priced into financial markets. This is more about case A and case B scenarios and how we manage that. So to begin, Governor Jonsson, if you could start off the discussion, please. The floor is yours. Maximum 15 minutes, and so we'll be sticking to that. So there will always be time later for comments and questions.
Is it actually working? Oh, yeah, it's working now. As I said, just want to thank you for being invited. Iceland is a very small open economy, so we feel affinity to other small open economies wherever they are. And in fact, we are only 400,000 people, so we are the smallest monetary area in the world that has its own independent monetary policy. And the best thing for us is that we have no neighbors, basically. We are an island. Our foreign policy is to let other nations alone, and hopefully they will leave us alone. So we are not a part of the European Union or any entity, although we are part of NATO, which is another thing. So 5 years ago, we celebrated 100 years of our currency. So I thought it would be fitting, since Armenia is now celebrating a 30-year anniversary, I should just talk about the lessons we have taken through the century of our independence. And by the way, Iceland has turned into a tourist boom in just a matter of 5 to 10 years. Only recently that we were only receiving 300,000 visitors only in the summer. Now we're receiving 2.5 million foreign guests each year. It's sometimes said that the financial system is a product of the financial crisis we've been through. And I just want to touch on how small systems deal with financial inflows. And I will just go quick. This is the rating of the Icelandic sovereign. And we did a lot of economic reforms in the 80s and 90s. We paid all our government debt. Iceland was practically debt-free in 2002, and we received a AAA, which was probably the worst thing that could have happened to us, because there was a huge financial inflow, which basically turned our financial system upside down, and it ended in the financial crisis where we were downgraded in a matter of 3 weeks. Just about young. And after having received the AAA rating, we have 3 systematically important banks. And they automatically assumed the same rating, since they thought to be too big to fail. And this is the rating of the biggest bank, Kaupthing, and it got all the way up to a AAA. And this is how our system grew. In 2007, when the financial crisis hit, we had a financial system that was 10 times our output. And in fact, we thought of our system of being a foreign system, but during the crisis, it went from being just in the view of the outside to be just an oversized system. And the banks went from being too big to fail to being too big to save. And the system went down. And we had the idea of having a international financial center. So we turned basically the upside down. We implemented emergency legislation, basically changing priority with deposits. we got branded as a terrorist entity by the British, for example, and we implemented capital controls, and which we actually have done. And behind capital controls, we reorganized our framework, our policy, and also our financial system. And this is the result of that reorganization. From being a country with a very negative net foreign position to being into a positive. I just want to then follow this by taking the 6 lessons that we've taken, which are here as well. And the question was asked in the last panel if you could basically separate monetary policy and macro-pro. In my view, you can't, and you cannot. You cannot either separate supervision from monetary policy and macro-pro. And I think that's the lesson from the regional bank crisis in the U.S., where you have a poor financial supervision being the root of a crisis. So, but it's very important for a small open economy. You have to control your balance of payment in some way or another, and this is very important by Hale and Ray. And you can do that by imposing capital controls, but they are very expensive. They entail a lot of welfare loss. But you can do it by implementing, for a small open economy, you can use micro-prudential tools to get control of financial flows. And first of all, that the central bank was merged with the FSA. That happened basically 3 years ago, so there is no question. There is just one entity in charge of the financial system. We now have 3 committees taking decisions concerning monetary policy, financial stability measures, and supervision. They have, I do chair, as a governor of the central bank, I do chair all 3 of them, but I have only 1 vote in them. And we have external members. And there is a complete transparency, which is very important. To gain trust, you have to be transparent. Second lesson, we built up huge foreign reserves. That's the opportunity we used in just 5 years after the volcanic eruption of Eyjafjallajökull, which closed down the air traffic in the Atlantic for 3 weeks. Iceland became the most hated country in the world, but it turned out that all publicity is good publicity. And the number of foreign visitors went from 300,000 up to about 3 million in 5 years, and we accumulated foreign reserves, which we have been using strategically since then. We have limited the ability of domestic actors to use foreign credit. The banks cannot lend in foreign credit unless there are entities that have foreign revenue. We monitor also their exposures. We have limited the scope for FX futures. They can only issue derivatives value to half of their equity. And we expect to use that for domestic parties, for exporters, importers, not for speculators. Because we basically want to prevent any short-term speculators from being in our country. We also have capital inflow measures, and I could also reflect on that. Iceland became the first country to seek the first developed country to seek the assistance of the IMF in 2008, and we've enjoyed a very good cooperation with the IMF concerning these measures. And we have, just to say that we feel a great deal of gratitude for the fund, for the technical assistance they have provided us with. Third lesson. We have macro-prudential needed to manage leverage ratios and constrain credit growth. Because in a small open economy, if you lose control of credit growth, you lose control of the balance of payment. banks have the ability to create money. If you allow them to create too much, it will lead to the money flows out of the country either through financial flows or through a deficit. So we have implemented very strict capital buffers. All of the banks have 20–30% capital equity ratios. We have imposed borrower-based measures. The banks cannot lend to households unless you have to have a very strict measures. Fourth lesson, financial supervision. You have to have a full transparency concerning financial supervision. So when we take actions against banks or any actors, this is publicized. We publish all our reports. This is fully in the open, which can be difficult at times. Enforce strict rules on bonuses, strict rules on related parties, strict fit and proper requirements for board members, and these measures have not been popular, but they have worked. Fifth lesson is the labor market. In Scandinavia, we like to think of the labor market as being a policy tool. We tend to think that there should be some kind of a consensus agreement concerning wages and social benefits. We've had trouble with our unions, great trouble actually, but it's and since we're a very small country, we don't agree on relative wages. It's a problem. We say that our country was founded by people from Norway that ran away from Norway because they didn't want to live under a king. In Iceland, everyone could be his own king, basically. So there have been constant labor problems, which has been our main problems. Sixth lesson, policy needs political support. It's impossible for the central bank to act alone. The politics have to be behind the central bank, always and everywhere. If the central bank loses political support, he cannot ensure the policy that is being described, and it's very common for politicians to blame the central banks for failures, which are really the failures of the political system. So these are the 6 lessons that we have thought for our system. Transparency is the key here, and you really have to integrate all these 3 aspects: macro-pro, monetary policy, and supervision. Thank you.
Okay, good. So I think that was just a wonderful discussion, Governor, about explaining how to think about the monetary transmission mechanism, the way that you used the concept of money and so on, and the risks of excessive credit expansions, and the story about how Iceland went from a very exotic, risky way of running business in a central bank to now something where you've shut down your financial system and tried to prevent a lot of these exotic things from going on. And those are the trade-offs, the very, very fundamental trade-offs that policymakers face is about making your economy less risky. And of course, that implies raising the cost of financing and reducing credit. What I was wondering, to connect it to digitalization, and this, unfortunately, the fourth speaker, there are some problems and they might not actually be here. But the question I want you to think about is, will digitalization potentially help at managing financial stability risks. Okay, but I'm going to put that aside. Hovannes has given us some questions to poll the audience. Okay, and these concern the other three presentations. The last presentation, unfortunately, which is the one that I was really interested in, because it meant we was going to talk about responsible artificial intelligence. I have been involved in a little project thinking about the implications of artificial intelligence. And I just want to tell you one story. This is a retired person, okay, that works with me, who is a marketing genius, okay, which meant that he managed a massive number of people. Okay, that's what happens when you're a marketing genius, that you have all these people working, and he hated the process of work. Okay, in other words, all the things that we have to do as managers and as governors and deputy governors and staff, we have to manage all this process. So he retired. Well, I got back from Armenia and went golfing with him, and he was so excited to talk to me because he said, "Doug, I'm back at work." And I said, "Well, why is that?" And he said, "Well, because I just bought a company in Mumbai, and I don't have to deal with any people anymore." I said, "Well, what do you mean you don't have to deal with any people?" And he says, "All the people that I had to deal with, you know, hundreds of people, don't need them anymore. I can go with artificial intelligence, I can go directly with my marketing idea directly to the customer. And guess what? It's making money." Okay? So the implications of that, I want you guys to think about that for a second. The implications of that is we're not talking about just replacing low-skilled workers. We're talking about replacing workers that we would typically regard as high-skilled workers, and those high-skilled workers might not have functions anymore. And the question is, do we have the policies to think about that? Do we have the policies, you know, to think about all these big issues that we're going to be facing down the road? And so that's, unfortunately, the last speaker wasn't able. There's some technical problems, but we're going to do a little poll now, because then we're going to ask Galina to talk about climate change and whether or not it's priced into financial markets, and what are the potential implications for capital controls in the future, or not capital controls, but capital flows. But can we first start by taking the poll about these more general issues, so we can get an idea whether or not the audience shares some of the concerns that I share about the case A scenarios where we have to do a lot more work versus the case B scenarios where we basically just hope for luck and hope these problems get solved. Or so could we please start by turning the poll on? Okay, so and then maybe can we show people the questions? Okay. So we're simply just asking you to pick two answers for two questions, so we can measure how much intense you are about the issues that we're going to be talking about. So now we're going to shift gears to climate change. I've had already the pleasure of asking Galina about many of these issues last night, and it was a wonderful pleasure for her to inform me about some of these issues. So please, can you explain what you were saying to me last night? I'm sure they would love that.
My slides up on the screen? While this is happening, I want to thank the organizers for inviting me to speak at this conference. It's a great honor, and it's also very wonderful to be back in Armenia. I fell in love with Caucasus about 35 years ago as a child, and it's only the first time I'm back. I've been trying to come back for a long time, so when I got an invitation, it was an immediate yes from me. Thank you. So, and I have the clicker, I guess. So I was asked to talk about climate risks and the future pattern of capital flows all in 15 minutes. So I'm going to try to skip around a little bit on a number of topics. I have a lot of slides. You can use them as a reference. The organizers have them, so I don't have to cover everything. What I'm going to say is based on about 4 projects that I'm working on with a number of very talented PhD students and colleagues. So I'm going to skip that information. It's in the slides. So I want you to think about the fact that the financial system has a two-way connection to the climate change. In one direction, climate risks are affecting financial markets. They're affecting capital flows through 2 types of risks I'm going to talk in a minute. They're regulatory risks, they're credit risks, collateral risks, and the asset value risks. And from my understanding of the literature, as of today, we do not have a confidence that those risks cannot be systemic. Right? So we cannot rule out systemic financial risks from any of those types of climate change risks. And that's where a lot of the literature is. But what we're talking less about is that we really need private financial markets to fund the climate solutions. And we'll look at the poll results in a few minutes, but yes, to encourage innovation and especially to encourage the implementation of existing technologies that are climate solutions, we need financial investment into these climate solutions. And we're talking mostly about mitigation these days, but increasingly we need to talk about adaptation solutions because climate change is here, we're feeling its effects, it's affecting every aspect of our lives, and we need to figure out how to protect people, property, and nature from the harms that come from the climate change. 2 main types of risks. They're physical risks that come from climate change, the increased frequency of natural disasters. What I also want to emphasize is that as the temperature increasing a little bit, the temperature and precipitation in the tails of the distribution could be changing a lot. Hot places get hotter. So Central Valley of California is year after year 5 degrees Celsius warmer than it used to be. And so that is not the little 1-2 degrees that we're discussing. This is 5 degrees, which is making a difference between being able to grow some crops and not being able to grow some crops. And the same is happening with precipitation. So these are major events. There are also transition risks, which people usually think about coming from policies, but they also could be coming from new technologies, and they could be coming from changing consumer preferences, or the combination of all the 3. How would these risks affect capital flows? The short answer to that, it's actually quite complicated. It's complicated even if you can measure everything. But then it's more complicated by the fact that we don't have really good measures of how climate type of risks have affected financial markets in the past. And we also have a problem that the past is not a good predictor of the future in this case, because a lot of climate change effects are non-linear and non-stationary. You cannot just look at the past and say, well, that's how it's going to work in the future. So it's complicated. Now, what do we know? Maybe I'll just skip through some slides. I did some work on foreign direct investment. When you have foreign direct investment, and the country to which this investment is going is hit by climate shocks, for this foreign direct investment going to leave, or are they going to stay? Are they going to increase? Are they going to double down? And the answer to that really depends on the productivity. So in this example here, we have FDI inflows up to a certain level of productivity, which would be the horizontal axis. And you have 2 types of productivity countries, say highly productive, the purple country, and less productive, the red country. Right? So then if we hit this economy with a climate shock, FDI inflows are going to shrink, so the threshold is going to go up. And in this particular case, you can see more productive country is going to be affected more than the less productive country. And that's what the pink area underneath the curve is how you see that. Okay? So you look at this model, you say, okay, so when there are more climate risks, we're going to see rich countries losing more foreign direct investment. It's counterintuitive, but it can happen, and it is what the model predicts in this case. However, we can have another case when the threshold is in a different place, and if there is a climate shock, highly productive country is not affected at all, but a lower productivity country is affected a lot. So money is going out of more developing countries and into more developed countries. The reason we cannot tell which scenario we're in is because we are not measuring the relevant productivity very well, in case here is emission productivity. How much output per unit of emissions is the economy producing? And that's one of the things that we need to gather globally at the firm level, and it's going to take a big effort by a lot of coordination across countries to make sure we measure things consistently across countries so that there is no discrepancies in interpretation. And that, of course, would also allow for regulation down the road. I'll skip this. Now, do firms pay attention to climate risks? There's this wonderful paper by Sontner and co-authors that are basically using AI to read the corporate calls information and to see how much do people actually talk about climate risks in earning calls. And what they find out is that after the COP21 Paris, there is an increased mentioning by firms, and these are global publicly traded firms, to climate risks. So you would expect firms, multinationals, to be very attentive to what's going on with the climate risks, and we should expect reallocation of their affiliates across countries because of the climate change. For emerging markets, I want to emphasize agriculture. You can see that foreign direct investment is extremely important for agriculture. And on the left is you have outflows of FDI to agriculture, and you have inflows on the right. And these are very likely to change. The patterns are very likely to change because the productivity of agricultural crops is going to change dramatically in the next decade. Agriculture is also a big contributor to climate change. About a quarter of global emissions is coming from agriculture. In some countries like New Zealand, half of their greenhouse gas emissions is coming from agriculture. And that kind of information is not generally available, so it's another kind of data that we need. What are the industries that are actually producing emissions in different countries? It might not be an energy sector, it might be urban sector. In cold countries, we use a lot of heating. In hot countries, we use a lot of cooling. It could be transportation, but agriculture in many countries is a big culprit, and we need to know these things. I'll skip this. So, are the climate risks priced in? There is a lot of literature on this. What we find is that it does vary by asset class. So for the syndicated bank loans, we find that there is a very little greening despite a lot of efforts by NGFS and financial regulators and the central banks. The banks are not funding climate solutions. We don't know much about cross-border bank lending in terms of the portfolio, whether it's going to actual climate solutions or whether they're just reducing their investment in the industries that tend to have high emissions and moving money into unrelated industries like insurance and things like that that don't actually produce any alternatives. And I have all the references hyperlinked for those who want to read. We also know that the banks, when they're exposed to shocks, they transmit those shocks globally. So if the country A, say, hit by a shock, and the bank is located in a different country, that bank is going to reduce lending to domestic firms and is going to also reduce lending to firms in country B that is not affected by the shocks. So the banks global banks view their portfolios as global portfolios. And when there is a hit to their asset side in one country, they tend to reduce lending in other countries. Now, what about portfolio? Equity, we see very small reward for greening. So for a given firm, if it improves its technology and becomes more green, it gets rewarded in the stock market. But the numbers are really, really small. So if the portfolio reduces, the your portfolio is greener by a whole standard deviation, the Sharpe ratio only goes down by 1.5%, which is tiny, tiny, tiny. And most effects are after the Paris Accord, but the numbers are very little. So stock markets are recognizing the need for greening and they're rewarding greening technology, but not enough to encourage substantial amount of investment into climate solutions. Sovereign bonds, the same story. If you issue a sovereign green bond, you might save 2 to 7 basis points. As you know, 2 to 7 basis points has not made anybody happy or unhappy. It's just not material. There are bigger numbers for CDS spreads, and catastrophe bonds are now becoming, more traded and therefore better priced, but it's still not there in terms of getting incentives for the countries to invest in climate solutions. I'll skip the corporate bonds, the same story. So here's really the gist. The IPCC says we need to invest about $6 trillion a year globally into climate solutions. This is 10 times more than what we do now. You cannot expect the governments to increase their expenses on climate solution by a factor of 10, because as we just discussed in the previous panel, nobody has the money, right? So we need to get financial markets to start participating, and you have a pie chart that shows essentially what the pie chart shows is that financial markets are not participating in climate investment. And they need to start investing. And, $6 trillion sounds like a lot of money, but in fact, in the context of global financial markets, we're talking about 3 to 5% of total global assets under management. And now you will understand why I'm more optimistic about climate solutions being possible, because if we can just convince, somehow incentivize private global financial markets to invest in the right climate solutions, we're only talking about 3 to 5% of total assets under management. That doesn't sound like a crazy number that we can't lift. Climate solutions could be a hedge for climate risks. What can the governments do? Right? So what the governments do right now is essentially providing direct incentive for non-financial sector, for example, to alternative energy, alternative transportation. We also need alternatives to food technologies. But the governments can do more without spending an extra penny, right? So the money could be used more effectively by catalyzing private finance, maybe through public-private partnerships, so it's not the 100% of the money that government has spent. On the road here from Yerevan, I saw a lot of solar panels in the field. I don't know how those would be funded. I hope there is a private investment in those, because they have positive net present value. They have to be funded by private sector. It's not the government. We need really anti-greenwashing regulation, because otherwise people don't believe in any of the green assets, and it's a problem. We need to require appropriate disclosures so that there is data, and we need to have marketplace for adaptation in addition to mitigation. And this is really the way I think about how can the government really serve as a catalyst for funding climate solutions. You can think about all the climate solution projects falling into one of those 3 buckets. One bucket would be the solutions that actually have an attractive investment profile, nice net present value, good timing and everything. Traditional investment should be interested in that, or green investment, and there is no need for government or non-government organization involvement. There could be some borderline projects in the middle that maybe are not that attractive to private sector, because maybe they have too much risk, or maybe ROI is just too low, or maybe the time profile is not good. And so what the government can help is supplement it with a grant to boost an ROI. It can take, it can de-risk it by providing some guarantees, and that costs a lot less than funding the projects directly. And then, of course, there would be projects, and mostly these are adaptation projects that fall in this bucket for the communities, low-income communities, vulnerable communities that are affected by physical climate risks. there would be no private investment, and that's where the government can then focus whatever money is available. So I think by thinking in this framework, each dollar of the government spending can go a lot further towards getting to this $6 trillion that we need globally. Okay, I'm going to summarize. Capital flows are already affected by climate change, and they will be affected more in the future. And I think actually there is a risk that they will be affected a lot more, because if the firms are not responding enough today, they might wake up one day and say, oh, I don't want to be in that country, there are too many floods or hurricanes or whatnot. Private capital flows need to be directed to investment for climate solution, and that includes alternative energy, transportation, food technologies, and adaptation. And the government should aim to catalyze private finance rather than fund the climate solutions directly, because we will never have enough money to fund the climate solutions directly. And I'll stop here.
So that was a wonderful presentation. And I'm just going to warm you up with a question, but you don't have to answer it now. And it's also directed to the governor. But really, I'm warming them up for you guys. Okay, so think of your questions and so on. So $6 trillion, is that a big number? I want you to think about something, about what a really big number is. During the expansionary monetary and fiscal policies in the US economy, going through COVID, the US household balance sheet, which is measured by the Federal Reserve Board of Governors this is actually some data that are measured well. We have a lot of data, things like wages that are measured really badly, and so on. This number grew $43 trillion, okay? So from the trough of the end of March in 2020, remember asset prices fell a little bit, the NASDAQ went down and then doubled, went up to 16,000. Well, when you add all that up, you add the equities, you add the increase in house prices, and you add up the financial saving during COVID, that number is $43 trillion from the trough to the peak. We're talking $6 trillion here, okay? $43 trillion is over 2 times 2019 GDP. We are sitting probably on the biggest bubble, unless we get lucky and we get some technology from somewhere. We get some underlying growth fundamentals going. So my question is that when you take a market perspective of whether or not things are priced in aggregate, the answer clearly is not, because before every global financial crisis, before any crisis, it's not priced in. I mean, that's what the essence of the problem is in some sense. So I just wanted to ask you that question, both to the governor and Galina. Now, data. Maybe there's something positive here from this new technology. And so Bruno's going to take us through what he thinks the technology means for developing new types of data for understanding the issues that we're struggling with along many different dimensions.
Okay, so many thanks. I was told not to have slides. Good afternoon, Mr. President, ladies and gentlemen. Many thanks to the organizers and to the governor for the invitation. So I'm really delighted to be here at the Central Bank of Armenia. Central Bank of Armenia is actively involved in our committee on statistics. We have committees in Basel for regulation, for payments, but we have one for statistics. And Central Bank of Armenia is very active in this Irving Fisher Committee on Statistics, which is grouping more than 100 central banks on official statistics in the world. So I have been invited to present some views on the future of economic data from a central banking perspective. In fact, Mark, it's part of the compass that you were mentioning. Data, I believe, can help central banks to manage the future. And the topic of the new data needs has been high on the agenda in Basel, in the statistical community. My presentation is based on work that was published and was done with Saira Jahangir Abdelrahman from Central Bank of Suriname. Let me start by saying that during COVID-19, official statistics had to quickly adapt. And two important aspects. One is that central banks are heavy users of data. And they have to have data to conduct their policy, and they have to have data to manage the consequences of the crisis. But second aspect is that central banks are also key producers of statistics. So they had to respond to the data disruptions that we've observed, and also to the new data needs that we saw, especially, for example, in climate change. So now the global health situation seems to have stabilized. And one view is that we should go back to the previous situation, so kind of normalization. But another view is that the pandemic has triggered a fundamental reassessment on the way to produce and consume economic data in the new normal state of the world. So today I would like to discuss some long-term lessons of the pandemic, look at some challenges and the way forward. Let me start by the lessons of the pandemic for data users. A key issue for data is that it has to meet the test of practical utility. So the data, they have to address the information needs of the government, of the economy, of the public at large. And there are two lessons from this perspective. One is that we have to keep central banks' statistics relevant for users, for the public. So the statistical landscape will continue to evolve to adapt to the situation and to evolving user needs. And to do this, we need to have a statistical infrastructure that is nimble and granular. And the trade-off also between producing new data and the cost of producing this data and the benefits should always be in our mind. And of course, people need to understand why we publish this data, why it's important for the public good. So as regards the central banks, really the pandemic showed that the data they collect are crucial. And the statistical responsibility of central banks has not fundamentally changed. And it relies on four main points. First, the data collection of central banks are clearly linked to the mandates of the central banks. Second, the principles governing official statistics are rigorously applied. Third, high quality data are key to support policy decisions and then the effectiveness of these decisions. And the last point is that there must be a focus on securing public trust in this data. Think of the debate we had today on inflation. The worst would be that people do not believe the data on inflation. But the second lesson for central banks as users of statistics is that internal users' needs are key to support evidence-based policy. So central banks are key consumers of data to conduct the policies. They need the right information at the right time to properly design, calibrate, monitor their actions. And looking forward, we need to have a number of critical aspects in mind to support this evidence-based policy making. First, we need to secure the involvement of subject matter experts in policy discussions. A good example is climate change. Second, we need to prioritize. We don't have infinitive resources, so we need to focus on where we need to collect information. Third, we cannot act alone. We need to have international collaboration. And the last point is that we should be able to leverage more on data science and on all these new opportunities provided by data that are available. I will come back on this. Let me turn to the second impact of COVID for data producers, of which central banks. There are three main lessons. First, we realize that we need to make a sense of the wealth of data that is already there. So there was a lot of data there that we are not using. And this data, we call this organic data. So they are a consequence of the activities of the government, of the financial institutions. So with COVID, with the producers, they really realized that there were disruptions in key sources of information. For example, it was impossible to have industrial production or unemployment rates. We had methodological issues. We had data quality shortcomings. So I guess central banks reacted very pragmatically and rapidly to look at new big data sources. But it also represented a wake-up call. So really the recognition that a wealth of data was existing and we are not leveraging this wealth of data. A good example is administrative data registers that have been here for years. So these records that are created in an automatic way, especially by government agencies. Now we realize that we need to make sense of this data. Financial big data source is another example. And of course, the large data collections that we have collectively started after the great financial crisis. And here I would like to emphasize the role of the IMF, the BIS, all the international organizations working together on what we have called the Data Gaps Initiative. So the second lesson is that in addition to look at the wealth of data that is already there, we need also to produce more timely and high-frequency indicators. And this was clearly highlighted during the pandemic. The problem is that in official statistics, we spend a lot of time to ensure accuracy, comparability, so we take time. And of course, alternative data sets, they can be compiled quickly, but then in terms of quality, you have issues. So this trade-off between accuracy and timeliness is not new for official statisticians. But what is really new is that we have changed our way of looking at this trade-off. Because during the COVID pandemic, there was this kind of statistical darkness. We didn't know where we were. So the trade-off has changed, and I think central banks have realized that there's more emphasis now to produce more timely indicators and to have high-frequency data sources and to have more nowcasting exercise. The third lesson is, of course, to have new types of indicator. There are a lot more statistics that have been published, especially since COVID, but let me mention economic sentiment indicators based on the text mining tools or mobility data, etc. Now I would like to turn to looking forward and to say, well, in fact also what we saw is that we are facing important challenges in the statistical area, and they are not so new. But they are challenges that have been perhaps neglected for too long. And the first challenge is globalization. We mentioned this, but we know that globalization has a big impact on statistics, on domestic national statistics. And there are, I would say, at least four main types of deficiencies. One is that we don't have good data at the group level of multinationals. Second, we don't have good cross-border view on what's going on because we don't have international sharing of information. Third, corporate restructuring is quite complex and difficult to understand for statisticians, for example. And lastly, the data collection systems are national. They are not flexible enough, are relatively rigid to tackle globalization. And these limitations are obvious for central banks as compilers of BOP, of FDI. We know that it's very difficult to identify the chains of controls, for example. It's also very difficult for the economy more generally. Remember the distortion in aggregate economic figures with the Irish case in 2015, when suddenly we changed the estimation of global GDP in the country because of this impact of multinationals. The second challenge is the impact of innovation on finance. And this is what we call, of course, fintech. I think we have three main issues. One is that now these financial activities are no more performed only by financial firms. They're also performed by, for example, IT providers. So in terms of data, we don't really know what we are looking at. The data are not well classified, and there is a lack of international harmonization to measure fintech. Same thing for the digital assets. We don't have consistent, feasible, and appropriate treatment of the digital assets across the world. And the last point on fintech, which relates to another mandate of the central banks, is financial inclusion. So one issue is how to monitor that the use of the new financial services is done by a population that understands the risk. But the third challenge, I can go rapidly on this, is of course sustainable development. We have been told, I really think that during COVID we paid much more attention to this environmental, social and governance aspect. As was said, we lack international comparable data standards, etc., taxonomies. To do that, central banks are doing a lot. There is a lot of, as well as said, the network on greening the financial system, of network of central banks. There is also the new Data Gaps Initiative that is led by the IMF with all international organizations. We will have a lot of work on climate change, but there is, as I said, a lot of work, and it will take a lot of time. For example, in terms of shortcomings, we don't have a good view of the carbon footprints of firms globally. We don't have a good understanding of what are the forward-looking climate indicators, etc., etc. So, a lot of things, a lot of challenges that have been neglected, but we can at least have three supportive factors looking forward. The first factor is innovation. And go back to your point, the new normal for statisticians in central banks will rely on the use of data science. So we have much more interest in big data, being not only the Internet of Things, but also this large micro data sets that I was referring to. And we have also a lot of interest in these new innovative analytical techniques. And we really think, and we are already seeing that in central banks, that it can improve in data granularity, flexibility, timeliness, accuracy, and efficiency. We have also use cases showing that this new data, these new tools can support macroeconomic analysis, market monitoring, financial risk assessment, and of course, the statistical production of the central banks itself. But nevertheless, we have a lot of challenges. First, there may be a false sense of accuracy because the data are very large. You think the data are accurate, which is not always true. There is also the risk, as we know, of algorithm unfairness. There is the issue of communicating with things that are perceived as a black box, especially for the public, and of course, privacy protection, confidentiality. So all this calls for good internal data governance frameworks in central banks. We need to make the data users understand that the data we provide, what are the limitations, what is the uncertainty. So we need to be very transparent to recall what was just said before. The second supportive factor is what I would call the microdata revolution. So, as I said, there is a large amount of information that has been traditionally available, was not really used, and now is beginning to be used. But for this, we need to enhance data sharing. And this is also something, so data sharing at the domestic level between various public bodies, but also internationally. And it's a key element of the new Data Gaps initiative. Good example on the value of this micro-level information is that if you have firm-level data, you can better assess global value chains and also globalization. You can better assess the impact of climate change on the risk profile of financial institutions. You can also better monitor financial markets, etc., etc. And the third supportive factor is that we believe we are building a better global statistical infrastructure. Central banks are doing a lot since the great financial crisis in terms of registers, in terms of identifiers, in terms of statistical standards, in terms of data sharing. And on methodologies, there is a lot of going on in the context of the DGI, I was mentioning, but also the revision of the international statistical manuals. Last but not least, okay, yeah,
some time for questions,
is international cooperation. So cooperation between central banks, but also with counterparts in national statistical systems, but also with private providers to have them helping us to access these new alternative data sets. And the last one is also cooperation with the public at large and also to the academic community so that it can have access to the data that all the central banks have, and we are working on this. So, to summarize, yes, it will be a new normal for statisticians, a lot of challenges, but there is a lot of things going on to address these challenges. Thank you very much.
Yeah. Okay, excellent. So I want to go to the audience now. Maybe we can bring the poll up. Unfortunately, Mr. Zhang, there was a technical problem at the end and couldn't talk about this issue about the future of responsible artificial intelligence and central bank digital currencies and so on. So I had to kind of fill in for him, which obviously I'm not an expert in that area, but hopefully it got you warmed up to some of the issues and so on. But maybe questions for the panelists. You could just grab the, yes, Armin, please, and then the governor.
Thanks very much. The topic of the panel, the big topic, is the global financial infrastructure. And we have been talking about different types of risks. Governor first talked about the role of international capital flows, They can be a blessing, but they can also be very, very bad. We also, Galina talked about the pattern of international capital flows, sometimes surprising. But the question is the following: do you think the global financial infrastructure as we have it now is a shock amplifier, or it's a shock absorber? So is it helping us to solve these issues, or it's actually going to make everything worse? If it's going to amplify things, what really needs to be changed in this architecture? Thank you.
Yes, and Governor,
I do have a question on Iceland, and that was very, very interesting. Thank you very much. When you start curbing and then cutting on capital outflows, and then you ask your banks not to leverage in foreign currency, were you able, and then that is the asset side of their business, were you been able to limit the liability side of the banking so you don't have that open position which you should be dealing with? Because in our case, we did something similar to your case. For the physical persons, we put the limitations on consumer credit and mortgage credit for the households. But at the same time, we understood that the savings which are kept by our population are mainly dollarized. And then banks would have an open position which they either should hedge, or they would be somehow evoking the limitations that the central bank imposing on them.
okay, so I think we probably, Governor, maybe you could take the lead, and then Galina.
Working, no.
I think it takes time, like a
Takes
couple of
time.
seconds, yeah.
If I could maybe get. Okay, work now. Okay, first of all, with the global financial system, I think that the global financial system has been a shock amplifier in the past, especially regarding past crises. But as we've seen, that this inflationary shock has been actually symmetric across the world. So basically, and that's because it's can be traced to COVID, which was a common shock, and also a change in food prices, and which is also kind of a common shock, and that's one of the reasons for why most of the central banks have been moving in tandem with each other. There are exceptions, notably the Bank of Japan. But more or less, most of the economies that are open have been experienced a very similar price shock or inflationary shock. So they have all been raising prices in the same order, and that's very important, because then we don't have seen this short-term speculation, which is very often traced to nominal interest differences, because if you are a currency speculator, you think about nominal rate differences, not about the real rate. It doesn't really matter to you. And so we have not seen. So I think in many ways that the global financial markets have been more of a shock absorber in the last inflationary bout, but nevertheless, I mean, a contractionary monetary policy in the US has a huge effect on small open economies, Iceland also, and it would be very difficult for us if we would not be get actually symmetric shocks. And but I think that in general, that for less developed economies, emerging market economies, they have to be very picky and they have to be very careful when they accept foreign inflow, because it can very, very quickly turn. And what our policy has been, and just to address your question, not to allow the banks or allow foreign inflow to come into our system through the balance sheets of the banks. Because you have a lot of other risks that follow, especially if you have systematically important banks. So what we try to get is to have the inflows through the markets, that the investors they buy securities directly, either equity or bonds, or they invest directly, and that's why that's the way we think that we can contain the risk, because allowing the banks to take foreign risk on their balance sheet is a risk to everyone. And I think since I see my old professor Jonsson here, which is very old, he's much older than I am, but it's no, I think he was actually fresh out of grad school. But when he talked to me, but we actually co-authored. We wrote a paper together on foreign risk on the balance sheet of the banks, and but it's very important. And in a small open economy, if one actor takes a loan in foreign currency, it is an external effect on everyone else. You have an effect on the currency, and you also might have an open position. After the crisis in Iceland and behind capital controls, we basically reorganized the balance sheets of the banks. So we basically forced them to move into domestic currency. Basically, all foreign liabilities were turned into kroner, and we have been very careful since not to allow them to expand on that.
Excellent. We have another comment, but maybe you can.
Yes, please.
Start,
yes,
please.
sorry.
Galina.
I want to address that question of shock transmitter. I think it depends a little bit on which financial market you're talking about. So I think the banks are definitely transmitting shocks. Are they dampening the shocks along the way, or are they amplifying them? And I think the way you need to think about is to think about where is the source of the shock and how big they are. So generally, the global banking system is a very tiered system, right? So there are like 58 global banks are responsible for 85% of all syndicated loans globally, right? And then there are the regional banks, and then there are small banks, national and other small banks, right? So if the shocks originate in the periphery, the banks are able to buffer those shocks, and when they transmit them to other countries, they transmit them less than 1-to-1, right? So they could be a shock absorber. But when the shocks hit the very core of that tiered system, like happened in 2008, 2007, 2008, then the shocks get amplified everywhere, right? So you have like a complicated hub and spokes. If you hit the spokes, it's okay, but if you hit the hub, the whole thing is affected, right? And, in terms of, derivative markets, carry trade, I think are generally destabilizing because of their speculative nature. They tend to overrun anything fundamental in both directions, and so they would absolutely be amplifying any kind of real shocks, I think. So for the climate shocks, I think these are not necessarily the acute shocks like we're talking about, right? But in the hypothetical, it again depends on where you see those climate shocks, right? So if you see physical shocks in the periphery, those could be dampened by the system. But if you see a big transition shock, like say $200 carbon tax implemented in all advanced economies at once, that could lead to major asset repricing and have systemic implications, kind of what we've seen in 2008, because it's affecting the core of the financial markets. Yeah, don't know if you agree.
Yeah, a follow-up. Go ahead.
I absolutely agree with what you said actually. That about the core and actually periphery. And just to take an example, when our capital account was completely open and we had high interest rates because we were fighting inflation prior to the 2008 crisis, then basically there were the same investors or speculators that were buying Icelandic kronur as they were buying South African rand, the kiwi, the Polish zloty, the other currencies. And then if they would, if there would be a trouble in South Africa, for example, they would be selling down the ISK, our currency, because they would get into a kind of a liquidity shortage. And it's very difficult also because as I see, I'm very in Iceland. I'm very happy if no one talks about the currency market. And the biggest success of a central banker is that no one thinks about you, and everything is going fine. Because, but we, if there is a currency volatility, the whole nation is turned into speculators. And there is a lot of creative energy that is diverted. And people that run businesses, they should be trying to make efficient choices, but they try to speculate on the currency. They think if they should, do a certain transaction a couple of weeks later or sooner. So it's very important to, in the conduct of monetary policy, to try to limit currency volatility.
Interesting. Okay, but maybe just to provide a short answer to
Sure. Okay.
to Armin's question, we saw the presentation earlier by the person from Tokyo, where she was talking about things like government debt, right? So we are in a system now. We created after the global financial crisis of macroprudential policies that gives preferential treatment to government debt, treats it like it's risk-free. So to answer your question, all you have to do is imagine a world where interest rates in the US could be 300 basis points higher, and then ask, with all this government debt that we have around the world, is it really going to be risk-free? Then ask, given that a lot of it is on the financial system's balance sheet, if it is not considered to be safe, what happens to the evaluation of risk of all of those institutions? So the answer is really obvious, and it's not going to take much to push some of these countries over the line. Okay, so there's no question we've got a financial system that has bet on government debt being risk-free, and we've loaded up on it. If we end up in a world of high interest rates, that could be very, very problematic. Okay, so that's a simple answer. Maybe there's one last comment, and then we'll call it a day.
It's a question for Bruno, and it has to do with your micro data story. You have all these companies, which are these marketplaces, which have all this transactional data. And I wanted to ask you if there's any discussion about kind of bringing that information into the statistical systems, telling these firms, oh, why don't you give us this information? Of course, not to be used in a commercial manner, okay? But it would create a completely different set of potential statistics. We could have kind of a daily GDP activity number and things like that. So I don't know if it would be good to have that data or not, but is there any thought about doing that and bringing that information into the statistical world?
Yes. First, that micro data, there is a lot of data that is public data that can be leveraged from the public institutions. Think of all the ministries, etc. And the problem is that these data are not shared. So it's very important to organize a better use of the data that is already, or even in central banks, between the supervisory function and the statistical function, etc., etc. But of course, you're right. From the private sphere, there is also, and in the context of the Data Gaps Initiative, we are thinking of having a way to access better these data sources. Some central banks are doing progress One example is in the UK, for example, they start to embed official statisticians in data providers so that they are able to use this data and to understand this data. Another example is in the US, what the Federal Reserve Board is doing, for example, for property price. They are working closely with a private firm, and key here is how to make this information trusted information. So, because in official statistics, you have principles, you rely, so there is a lot of credibility. The problem is that when you use data that has not this credibility, you have an issue with the public trust in what you are doing. You also have an issue with the actions that you are taking on the basis of the data. So the solution that the Fed has done for this particular example I have in mind, you have a kind of self-commitment of the private firms. They are saying, we are doing this, this, and this. For example, we are giving the data not for a business purpose, or we are giving this data, but we give also the metadata, the information of what we are doing to the Federal Reserve, etc., etc. So yes, there is a lot of ways to address this.
So I'd like to thank the speakers that were here. Bruno for a wonderful presentation taking us through the issues with data and the potential future and so on. Galina, thanks for a wonderful summary of some of the discussion in your response, as well as an amazing presentation. And Governor Jonsson, that was one of the best presentations about how to think about financial stability policy and how to learn lessons from the past. And of course, the audience for their wonderful participation. Dr. Zhang couldn't show up, but his title, Responsible Artificial Intelligence, Digital Assets, and the Future of Central Banking, I think that maybe should be a topic for conversation to dinner tonight. Okay, so, pardon? Can we see the poll answers, please? I can't show you the poll answers, that's for sure. But can somebody show the poll answers? Okay, sorry. Okay, so what are they? So the answers are transitioning to renewables. That looks pretty important. And encouraging green, that looks, again, very important as well. So the next question. Unfortunately, I can't read it. So can anybody read it? Okay, and that last one obviously is really, like, if you're into artificial intelligence, it is scary. So for me, who believes in anonymity, you know, the principles of having whistleblowers and stuff like that, I think this artificial intelligence is so scary that I would even start to question, you know, what are the benefits of anonymity if we allow other people to effectively take control over, you know, over basic things that we should be in charge of in democratic societies. So there are very, very incredible risks out there, and societies are basically going to have to choose those. So on that note, thank you very much for the wonderful presentations and